inflation is coming down. That's empirical. There's no debate about that. But it's coming down for really bad reasons, which is the economy is hitting the wall. And not just the US. This is a global phenomenon. We're looking at a global recession. If you understand how the economy really works, if you understand it's a complex dynamic system, you can get very good results. But if you stick to the Phillips curve and a lot of other nonsense the Fed uses, you're going to get it wrong.
You understand not to just batten down the hatches and survive through tough times. You know actually how to put the positions on that will thrive.
Despite the difficulties, we don't have to be victims. We're not helpless. We don't have to curl up in a ball. The key is to see it coming. If you can see things coming, you can deal with them accordingly. You can get through them, not only preserve wealth, but actually make money. So again, we're not helpless. We can do things about it.
You mentioned briefly the war in Ukraine. We're coming up on 1 year now. What do people not know about what's really going on there and how that knocks onto Europe, America, and maybe even to China?
This is not about Ukraine. This is a war with Russia that these people have wanted since 2000. They just hate Putin, period. They want to get rid of the guy. They're coming dangerously close to World War III. This is the closest we've come to a nuclear exchange since the Cuban Missile Crisis. You might be the guy who doesn't want the nuclear war, but if you think the other guy's going to shoot, you shoot first. Is Biden John Kennedy? I don't think so. He's on a reckless path. The most dangerous situation in terms of potential nuclear war since 1962, with a bunch of people who say, bring it on.
The world is changing. Inspiration is everywhere. It has never been so easy to connect, share, and bring people together. We're learning from others and finding the best in ourselves. Challenging our beliefs. Sharing our vulnerability. Overcoming our fears. Transforming ourselves so we can transform the world. How far can we go? This is London Real. I am Brian Rose. My guest today is... This is London Real. I am Brian Rose. My guest today is Jim Rickards, the American lawyer and investment banker turned economist, thought leader, and author. You have over 35 years of experience working in capital markets on Wall Street in senior positions at Citibank and the hedge fund Long-Term Capital Management, as well as being an advisor to the CIA and the Pentagon. As a highly sought-after financial expert, you have been a contributor to publications like the Financial Times, the Evening Standard, and the Washington Post. You have topped the New York Times bestseller list many times with titles including The Death of Money and Currency Wars, while your latest book, Sold Out, looks at the broken supply chain, surging inflation, and the catastrophic consequences of the global economy. Your desire is to help people prepare for the upcoming crash, which will be fast, bloody, and unavoidable, by teaching them how to protect their wealth and navigate this new economic reality. Jim, always a pleasure. Welcome back to London Real.
Thank you, Brian. It's great to be with you.
Great to sit down and have another in-depth conversation. I can't wait to jump in and get your take on what's currently happening globally. Before we get started, I just want to alert everybody watching to an important video that you've just recorded that will not be available to the public. Here, you discuss the upcoming crash that will be fast, bloody, and unavoidable, but you then explain how anyone can position themselves to profit from this crash. Our viewers can access that video at londonreal.tv/Jim, that's Jim, and I highly recommend that everyone go watch that immediately after our conversation. Jim, let's jump into it. We last spoke 6 months ago. What's your take on the way the world looks as we go into 2023? How is the global economy? Has the Fed engineered a soft landing or not?
Yeah, Brian, there's just at a very high level, I would say that there are a lot of difficulties, a lot of challenges. We'll talk about all of them in detail. But you sort of, people put words in your mouth and kind of get the reputation as this doom and gloom guy. Jim Rickards is always talking about the end of the world, which I don't. I never use that expression. But I make the point that, despite the difficulties, we don't have to be victims. We're not helpless. We don't have to curl up in a ball. The key is to see it coming. If you can see things coming, you can deal with them accordingly. You can get through them, not only preserve wealth, but actually make money. I always point out the example of Hugo Stinnes, and people go, who's that? He was an industrialist in Weimar, Germany in the early 1920s. And he could see the hyperinflation coming long before the middle class, long before anybody else. He went out and borrowed an enormous amount of Reichsmarks, that was the currency at the time, and just bought industrial assets, coal mines, vessels, natural resources, etc. So here comes the hyperinflation. He gives it a little time. He pays back his debts. I would say pennies on the dollar, like a millionth of a penny on the dollar, in other words. But he paid it back. They were sweeping the money down the sewers, but he paid back his debts and kept all the assets. And he became the richest man in Germany. And my German is not very good, but his nickname was the Inflationskönig, which means the inflation king. So there are other stories like it, Joseph Kennedy in the 1929 crash. But here's a guy who lived through the greatest hyperinflation of any modern industrial economy and ended up as the richest man in Germany because he saw it coming and made the right move. So again, we're not helpless. We can do things about it.
Yeah, what people probably don't know about you, but they'll soon learn, is that you're so experienced on Wall Street and understanding derivatives and understanding you can be on both sides of the market in many different forms through futures and options and all sorts of different ways, that exactly you understand not to just batten down the hatches and survive through tough times. Actually how to put the positions on that will thrive in those times. And I know that about you, and I think people are learning that about you. And it's true, people can be empowered in these times, and it's a much better way of going through this as opposed to just the doom and gloom, right?
Right. And but the key to empowerment, as I say, is to see it coming. That's where the analysis comes in. And you're like, gee, Jim, are you smarter than everybody else? Of course not. There are a lot of big brains around, but people have flawed models. They have there's a lot of behavioral psychology behind it, the confirmation bias, or believing the future will resemble the past, which it usually does not. So if you're going to stick to those models, you're going to get really bad results. It's hard to think of an institution that has a worse forecasting record than the Federal Reserve, the U.S. Federal Reserve, with the possible exception of the IMF. They're both pretty bad. I mean, you could almost take the Fed forecast, do the opposite, and be just fine. There's more to it than that, but they just stick to these really bad models. But if you understand how the economy really works, if you understand it's a complex dynamic system, all I've done is I've taken complexity theory, which has been around for a while. I mean, you could say 13 billion years because the Big Bang was the ultimate complex dynamic paradigm shift or a phase transition. But the science of complexity, understood in mathematical terms, really dates to the early 60s. But it's been used very successfully in physics. I've been at the Los Alamos National Laboratory, worked with the top people there. It has a lot of applications. All I did was bring it over to capital markets. I looked at capital markets and said, wait a second, here's one of the most complex dynamic systems you can picture. And then there's nothing more complex than the human brain. So you're putting humans on top of capital markets. You've got complexity squared or some exponent. And those models work brilliantly. But try getting anyone to understand it or do that work is difficult. But again, the point is, if you have the right models, and I would include behavioral psychology, a good dose of history, complexity theory, and a few other branches of applied mathematics, you can get very good results. But if you stick to, the Phillips curve and non-accelerating inflation, unemployment rate, and a lot of other nonsense the Fed uses, you're gonna get it wrong.
And one of the reasons that you kind of changed the way you looked at markets and started looking at these complex systems was because of what you experienced at Long-Term Capital Management. And that's why I was rereading your bio this morning, and I was like, the pieces started fitting in place. I mean, we've known each other for 6-7 years now, but I was starting to really understand your background. And for people who don't know, you had kind of made your first kind of fortune on Wall Street, gone to Long-Term Capital, put the money in Long-Term Capital, the smartest people in the room, from Nobel Prize winners to the top people on Wall Street, and then you watch that go bankrupt and almost take the financial system down. You had to also engineer that as general counsel, but I think that was your aha moment where you said, wait a second, even these people aren't looking at these markets intelligently. And then I think that's when you started developing these systems. Did I get that right?
That's a very good synopsis. I'm kind of working on my third fortune right now, but the first two it took a hickey back in 1998. But what happened is I had a long career on Wall Street, made a certain amount of money, came into long-term capital management in 1994 before the launch. So I was the only general counsel through the collapse in 1998. But I was the lawyer. Now, I'm not washing my hands of the risk management and all that. We work side by side with these guys. I mean, Myron, on a quiet day, Myron Scholes, who, is Nobel Prize winner in economics, inventor of the Black-Scholes formula, which is the basis of $1 quadrillion notional value of derivatives in the world. By the way, for people not familiar with the Q word, 1 quadrillion is 1,000 trillion. So that's how many derivatives, off balance sheet derivatives we have. But Myron, invented that formula that set the base of all of it. And, he would, really nice guy. And I'd be sitting at my desk and he'd walk in. I had a whiteboard and I would ask him some dumb question about the markets. And he would sit there and give me like a 2-hour tutorial. So can you imagine getting a private 2-hour tutorial from a Nobel Prize winner? So yeah, I was around when there weren't that many of us. But I was sort of the lawyer, very focused on that, compliance, contracts. I wrote the derivatives contract, so I was very immersed in all that. But I was kind of comfortable putting my money with the firm, including the money I'd made previously. I said, wait a second, these guys are, even the guys who didn't win the Nobel Prize had 160 IQs. They were the real deal. They were, one of them was the youngest full professor in the history of Harvard University and the vice chairman of the Federal Reserve. 2 Nobel Prize winners. John Merriweather was legendary on Wall Street. So that was the crowd. So I was at ease about the money, just very much focused on my job. And then when it all fell apart in 1998, I always say in the US system, it's true in the UK also, when things really, really, really go bad, they hand it to the lawyer. So like, hey, well, I can't deal with this. Give it to the lawyers. And so it can be a bankruptcy trustee. We did not go into bankruptcy, but a negotiator, a bailout expert. There are many people specialize in that. So I got the whole thing handed to me, and then we organized it and got through it. We were able to foam the runways and, with like 4 engines flaming, kind of bring it in for a soft landing. But I can tell you, Brian, from the inside, we were hours away from closing every exchange in the world sequentially. It would have started in Tokyo. We got a term sheet on a Wednesday, 5 days. Nobody slept. Nobody slept. In big law firms, I was working. We had a base at Skadden Arps. My office was up in Greenwich, but I was back and forth. So the first day, everyone looks like a lawyer. Second day, the ties come off. Third day, the jackets come off and the shirts are unbuttoned down to the middle of the chest. No one's showered or bathed or whatever. And it just gets grubbier, but you sort of power through it and get it done. And we did late on a Sunday night before Tokyo opened. But if it had fallen down and it came close, Tokyo Stock Exchange would have been closed. And then, Singapore and Paris and London and New York, they would have probably reopened a few days later, but it would have been a shock like nothing since the Great Depression. So, but the problem is we did get through it. And 2 things. Number one, it was 24 years ago. So 25 years ago almost. So people kind of fuzzing on it. If you're under 40, it's probably like a footnote in some economics book or whatever. But if you were there, it was pretty scary. But I came out of it. And of course, I lost money. One of the reasons we weren't lynched, there was no wrongdoing. There was a huge risk management failure and a huge financial loss, no doubt. But there was no wrongdoing. This was, I used to say we knew to the penny how much money we were losing because our accounting was really good. But we were looked at by the SEC and the CFTC, and there were no lawsuits, and so we kind of got through it all. Interestingly, some of the principals after long-term capital, you pick yourself up, you dust yourself off. They started new companies and made $1 billion. So they had the talent. We just had a very bad patch. But I sort of looked at it myself and said, well, wait a second. These people really were who they said they were. They really were that good. They really were the top brains in the world in this field. And yet they had this disastrous outcome, massive failure risk management. They're not dumb. They're not venal, but they must be doing something wrong. I don't mean in the moral legal sense. I mean, there must be something wrong in the model, in the way they understood markets, or you wouldn't have ended up that way. So I continued my career. I ran a stock exchange after that. It was not long after 9/11. I was tapped by the CIA and, did that for 10 years. But I never got over this. Well, what were they missing? And so then I just kind of on my own time, in my own way, I started exploring what could be wrong with the models, what assumptions were at odds with the facts. How did how did markets actually work, and what models did work? And then if you do that, it's not long before you discover, Benoit Mandelbrot and other analysts who had kind of got it right. Edward Lorenz, who was the founder of modern complexity theory. And then you sort of, you check the footnotes and read those articles. And the more I got into it, I said, hey, this is the right way to understand it. And then I started writing on that, lecturing on that. And then because of my national security work, I got tapped to go out to Los Alamos National Laboratory. And that's like, good luck getting in. That's harder to get in than any other place I've ever been. But it's on a mesa. So unless you're coming through the main access road, you got to be like a mountain climber to go up 1,000 feet. And then, you'll get attacked by dogs or whatever. But working with people who were simulating nuclear explosions in a supercomputer, because you can't blow things up anymore, but we still have to do the weapons development. But I was meeting with them to collaborate on taking that branch of physics and complexity theory and bring it to capital markets. So what was interesting, I would say something, well, I did say this, I would say, if we had used what we call team science or interdisciplinary approaches, as if we had some physicists, applied mathematicians, an economist, a lawyer, a behavioral psychologist, maybe an artist, I don't know, just a group, we could crack the code. We could figure this out. And the physicists were like, great idea. Let's put it together. Let's make a proposal. Let's get the funding. They love that. The Santa Fe Institute's right there, and they've got a lot of the same talent. But you would go to an economist and say, well, would you like to join this team? They would say, well, you have nothing to teach us. Why would we want to work with physicists? I mean, what does that have to do with economics? So interestingly, the biggest impediment to improving economic science were the economists themselves, because they're so drenched, marinated, I guess, in their own models, most of which are mistaken, that they can't see the way forward. So I got a lot out of that. I just started doing it myself, building my own models and working with teams. I've started companies that do that now. So I've had a lot of success with it.
It's interesting how you talk about how they went to the physicists, because again, like you said, Myron Scholes, like legend on Wall Street, pretty much responsible for the pricing of any option on Wall Street. We didn't have a shrine to him on the floor at Bankers Trust, but we all knew that the reason we had jobs was because we had the Black-Scholes model. We could price all of our derivatives. But that came, I think, from looking at things from a thermodynamics perspective, from that diffusion model is why first they cracked the code. And I know probably the finance and economists have been trying to figure out how to price an option for a long time. And then they kind of got that from the science guys. So again, a little surprised that the economists wouldn't know that, but then again, also not surprised.
Yeah, well, there was, it was Black-Scholes, it was Fisher-Black, Myron Scholes, but there was a third contributor, and he won the Nobel Prize, which was Robert C. Merton. Merton was at Harvard, and Fisher and Myron had worked on this for a long time and had come close, but weren't all the way there. They went to Merton to help with the math, actually, and Merton solved the math problem for them, but to his credit, and very generous, another really nice guy, he said, look, you guys go ahead and publish this, and then I'll tag along a few months later with my contribution. And the Nobel Prize is not awarded posthumously. So Fisher-Black sadly died before they got the prize. So Merton and Scholes won the prize. And again, to their credit, they pooled the award, divided by 3, and gave 1/3 to Fisher's widow, which I thought was very, appropriate and very generous of them. But it was a math problem. You write about what they call Brownian motion, which is random, and so it was sort of, you had a fan, if you will, of probabilities, and then different degree distributions, some more likely than others, et cetera. Having said that, and the success of Myron used to say, Jim, if only I had patented the idea and had like a fraction of a penny on all the notional value, I'd be the richest man in the world, which is probably true. Yeah. But they didn't. They put it in an academic journal. But Uh, there are assumptions in Black-Scholes which you can question. I'm not dinging the model. Science is always, hey, let's make it better. It doesn't mean you don't use what you have. But they assume a risk-free rate. Well, is there really anything like, is there a risk-free rate? Is the United States risk-free? I don't think so, actually, and it's getting riskier by the day. So you can kind of question that assumption. Does the future resemble the past with some probability, some degree of distribution probability? Not always. I mean, and maybe less frequently now than ever. And they also assume that prices move continuously. Prices go up and down, of course, but that you could get, if it were going up, you could get out of certain levels. If it were going down, you could put stop losses on your position and get out of certain levels. You could manage it. And of course, that was a big contributor to the 1987, October 19th, 1987 flash crash, when the market fell 22% in one day. I mean, today we get worked up if it's down 22% in a year, which it was last year approximately. But this is 22% in one day. But it turns out none of that's true. Markets don't move continuously, or if they do, it's when you don't care. When you do care, they just gap. They gap down or they gap up. You miss it, you blink, and it's at a completely different level. It's been repriced. Now you can still get in and out, but you've either made a lot of money or lost a lot of money, in the blink of an eye. So when you take those characteristics, and this is how I started kind of deconstructing it, if you will, and say, well, look, markets are not efficient. That's nonsense. They don't move continuously and slowly. They gap up and they gap down. And if you're not ready for that, you've missed the boat. Nothing's risk-free. So why don't we start there? When I started identifying those factors that, in my view, were incorrectly applied in long-term capital, but really everywhere, and you say, well, what looks like that? Well, the answer is a complex dynamic system. A system that produces hurricanes and tornadoes and lightning bolts and power outages and earthquakes and tsunamis. Those are all examples of the results of complex dynamic systems. An earthquake doesn't sneak up on you. It just the ground falls out from under you instantly. And that's what happens in markets. So then I said, well, maybe that's a better model. Of course, it is.
Yeah, really well said. Like you said, at the time, it was a breakthrough because you had these new concepts that all you needed was volatility, which again is a very general measure, and a risk-free rate. And you could, create an options price where everyone in the past was like, you need a expected rate of return and all these things that weren't true. But then when you look at it, especially a couple decades later, you realize it's making some very simplistic and general assumptions, which obviously have not proven true when you look at these crises. And like you said, that's when it matters. When it gaps is when you really need it to work, not when nothing's happening. So yeah, we definitely needed new things, which is what you've worked on. And so we spoke last about 6 months ago. I'm wondering, have your views of the world changed? Obviously, the Fed has dialed in a bunch of increases. I think some more projected this year, is telling us there's going to be a soft landing. But I think you disagree. Has your outlook on the future changed? And what do you see coming up for 23 and 24?
Yeah, I mean, things evolve all the time. Another tool, intellectual tool, applied mathematical tool, uses Bayes' theorem without getting too much in the weeds. And I learned Bayes' theorem at the CIA because I always say, if you have all the facts, a smart high school kid can solve the problem. The intelligence agencies and others, and people in capital markets, have to solve problems when you don't have all the facts. But you have no choice. In national security or defense, it's literally life or death. On Wall Street, it could be your fortune or your client's fortune. So you don't have the luxury of just throwing up your hands and say, "Well, I'm going to wait till I get more facts." That's what Janet Yellen did, but that doesn't work in the real world. She's kind of detached from that. So how do you solve problems when you don't have all the facts you need to really solve the problem, and you know it, but you have to deal with it anyway because it's coming at you? Well, Bayes' theorem says assign an initial probability, a priori assumption. Just not make it up, but do the best you can, recognizing that you're going to fall short, that you've got missing pieces in the puzzle, if you want to put it that way. And if you have no facts at all, and it's a binary outcome, give it 50-50. Like, it's like, it's not quite 50-50, but red or black on a roulette table, it's a little less than 50-50. It was close enough. He said, it's either going to be red or black, don't know which. I'm going to give it a 50-50. And then what you do, this is what statisticians hate, you update it based on subsequent facts. As new facts come in, you put them back in the model, you update it, and what you'll discover is that your probability either goes up or down. Well, if it goes down more than a certain amount, you discard it. You say, well, that's wrong. I just do it again with do something. But if it goes up, what you're doing is making it more and more likely that your assumption was true. And so eventually you can get up to the 80, 90% level. And that's not 100%, but it's pretty darn good. But there's a tension, which is, okay, as you're updating, and this is something that was explained to me by Henry Kissinger. So imagine a simple graph, and the vertical axis, the y-axis is the probability of a certain outcome, and the x-axis is a timeline. Well, the probability, or basically you convert that into the amount of information you have. How much information do I have? How much time do I have to make a decision? Well, at zero, at the outset, you have no information, or very little, but you have a lot of time. You have a lot of degrees of freedom. But as you move across the x-axis, as you move down the timeline, what you discover is you get more and more information, which is a good thing. So that curve is going up. But you have less and less time, fewer degrees of freedom. That curve is going down. So when you get all the way to the other end, it's like, hey, I have perfect information, but it's too late. It's over. I missed either, war started, or I lost all my money, or something bad happened. So what you look for is the sweet spot in the middle. We call it the Kissinger cross, where I have enough information to be smart, but enough time to have degrees of freedom and be able to act. You look for that sweet spot in the middle, and that's when you act. And with a little humility is a very good tool, a good addition to the formula. But that's what that's what Bayes does. Bayes gives you a mathematical basis for doing what I just described. So in as I say, in the CIA, you never have enough information. You're always trying to get more, but you have to do the best you can and kind of make assumptions and make forecasts, because you don't have the luxury of sitting back. You can't wait for 10 9/11 events so you can have a good statistical base. You got one, and you want to prevent the next one, and kind of how do you do that? So getting back to Jay Powell, so so my forecast, I do update them, but big picture, it goes as follows. So what is Jay Powell doing? First of all, not even a year ago, March 1st, 2022, the Fed fund policy rate, interest rates were 0. And we're now at 4.5%. Now, I know everyone goes back to the Volcker days, and I talked to Paul Volcker about this. 18%, 19%, 20%. Like, well, Powell's nowhere near there, but he's getting there fast. Even in the Volcker days, we never went up 4.5% in 10 months. Not that fast. And so here we are. So what is Powell doing? Well, he's given 5 speeches on the subject. I don't know why Wall Street doesn't listen, but he keeps trying. August 26th at Jackson Hole, September 21st at an FOMC meeting, again, November 2nd at an FOMC meeting, November 30th at the Brookings Institution, which is like a retirement home for, former Fed chiefs, Janet Yellen and Bernanke there. And then I think it was December 14th, could be off by a day, at another FOMC meeting. So he gave 5 speeches. He said the same thing every time. He said, inflation is job one. We're just going after inflation. Believe us. There is going to be a recession. Unemployment is going to go up. There's going to be pain. I've never heard a Fed chairman use the word pain. He used it 5 times in one paragraph in the Jackson Hole speech. And that's what we're doing. And believe us when we say it. And of course, Wall Street, comes up with their own narrative. Now, how long will he raise rates? How quickly? And what's he trying to do? Powell is trying to get to something that he calls the terminal rate. And what's the terminal rate? I don't know the number. Neither does Jay Powell. It's kind of like, as Potter Stewart would say, I'll know it when I see it. But he's trying to get to a terminal rate. But the definition of the terminal rate is it's a rate that's high enough to cause inflation to come down on its own without further hikes. So we'll get to a level, and then inflation is coming down, by the way. And in the last 5 months, in the U.S., it's gone from about 9% to 8.7, 8.2, 7.4, 7.1. So it is coming down. Having said that, the target is 2%, and 7.1 is still a far cry from 2. So he's not there, but he's making progress. Now, so here's I hate to use the word conundrum, but it kind of is. Wall Street's saying, you're done. You did it. Mission accomplished. Inflation is coming down. You got what you wanted. Give it time. Stop raising rates. You're going to kill the economy. But the Fed is saying, well, we actually don't know. We can't untangle it. Yes, inflation is coming down. That's objective. But is it coming down because we're still raising rates? Or is it coming down because we're at the terminal rate? Those are two different things. And right now, and this is what Powell's been saying, the Fed leans to the view that they're not at the terminal rate, that inflation is coming down because they're raising rates. They have not achieved the terminal rate. So my expectation is the Fed will raise interest rates 50 basis points on February 1st. We'll see. We got a few weeks to go, and that could change. Again, consistent with Bayesian updating, but they'll let us know. We'll know beforehand. And then probably 25 basis points in March. March 22nd is the Fed meeting after that. So those 75 plus the 450 we have now, that'll get you to 5.25. And even the more hawkish members think that that's probably the terminal rate. So so Powell and the Fed have said, yeah, inflation's coming down, but it's because we're raising rates, not because we're at the terminal rate. We're going to get to the terminal rate, probably 2 more hikes, and then we'll pause. And then if we're right, we'll just let inflation come down on its own. And that may take a year. So all this stuff about the Fed pivot and cutting rates and all that stuff, I mean, the Fed's thinking mid-2024 before they do that. Now, Wall Street, and I'll say markets, not just Wall Street, but the big money in arcane places like the Eurodollar futures curve, which is an interesting data point. We can talk about that, and the U.S. Treasury curve, which are highly inverted, are saying, no, you're not going to get that far. You may be at the terminal rate already. You're definitely going to cause a recession. It'll be more severe than you think. And rates are going to have to come down sooner than people expect. In other words, you've already achieved the terminal rate. You just don't know it, and you'll probably be the last to know. So with Wall Street, with cheerleaders, sending that message, but with some serious market indicators, including yield curves, sending that message. Why is Powell sticking to the game plan as I described it? And the answer goes back to 1980, believe it or not, and what's called the Volcker mistake. And everyone knows, Volcker became Fed chairman in 1979. He stayed on until the kind of early to mid 80s. And he did raise interest rates to 20% or very close to it to kill inflation, which went up to 15% at the time. I remember I actually got my first mortgage. I bought a condo in New York, and it was 1980, and my mortgage was 13%. I told my mother, and she cried. I mean, her first mortgage was like 2%, in the 1950s. I said, Mom, but you got to understand, inflation is 15, my mortgage is 13, so my real rate is -2, and it's tax deductible. I'm in a 50% bracket, so my real rate is -8. The bank's giving me, But anyway, that was just how things were at the time. But people forget that there was a recession in 1980. It was sharp but quick. It was over very quickly. It had nothing to do with monetary policy. The Carter administration issued some dopey regulation on a ceiling on credit card interest rates. And the industry said, fine, we're just not going to lend anybody any money. The economy fell instantly, kind of like a smaller version of what happened in 2020 with the pandemic panic. And then they said, oh, sorry, just kidding. And then they took the ceiling off, and then things got back to normal. But Volcker, now this was a time when farmers around the country were driving front loaders and tractors to Washington, and they were circling the Fed building. And one guy drove his tractor up the steps of the Fed, and Volcker was being burned in effigy. That all happened. So it was a little bit of pressure. And of course, Congress was up in arms, and the White House was up in arms. So Volcker, not quite panicked, but he cut interest rates 7 percentage points, not 0.7, 7 full percentage points to deal with the recession, which, number one, was unnecessary because the recession was caused by a policy blunder from the White House, which was quickly corrected. And number two, he had not won the fight against inflation. Well, after he cut rates and we came out of that very quick sort of snap recession, inflation got even worse. And that's when Volcker had to raise rates to 20%. And Volcker, in hindsight, and he said this in his last book, just before he died, he said, we shouldn't have done that. We should have stuck to our inflation mission. So now Powell, remember, Powell's not an economist, he's a lawyer, so he kind of thinks like a lawyer. I can relate to that, looking at both sides. Powell does not want to be that guy. He does not want to be the guy who balks early and cuts rates, the famous Wall Street pivot, before the battle against inflation is won, because the outcome could be exactly what Volcker experienced, which is inflation wasn't done, doesn't go away, comes back stronger, and then you do have to destroy the economy, as we did in 1981-82. That was the worst recession. That was far worse than the little one in 1980. That was the worst since the Great Depression. We've managed to break that record several times since then, but at the time that was horrific. But Volcker and others have said that was a blunder. He never should have done. So Powell does not want to give up the rate hikes too early because he does not want to repeat the Volcker mistake. He does not want to be that guy. And that's what's driving him, even as Wall Street screams, you're already there. So the question, so that's the lay of the land. There's the two competing sides. How does this play out? In my view, Powell probably is there. He probably is at something like a terminal rate. He probably doesn't have to raise interest rates anymore. He doesn't believe that himself. His models tell him otherwise because they're relying on the Phillips curve, which is junk science. I mean, the last time I looked at a Phillips curve, it was flat. At least where I went to school, curve was curved. This thing is flat. There is no correlation between unemployment and inflation. There just isn't. But the Fed thinks there is. So I always tell people, don't. If you want to forecast Fed policy and understand the Fed, don't think like a rational person. You have to think like the Fed, because you have to get inside their heads, or else you're going to get it wrong. So they're looking at unemployment, which is the lowest. The unemployment rate is the lowest since 1969. Well, if you believe in the Phillips curve, then that's a sure sign of inflation. As I say, even though it's coming down, it's still pretty high. So they think they have to keep fighting this fight. But here's what they're missing. Here's where it all falls down. Yeah, inflation as measured, CPI, PPI, personal consumption expenditure, core, non-core, year over year. There are like 20 different ways to measure it. It is coming down, but there are two sources of inflation, and it's going to sound obvious, but you got to separate them: the supply side and the demand side. They both result in price increases, but they have completely different dynamics. Supply side inflation is what we're seeing. It's what we saw in 1974 with the Arab oil embargo during the Arab-Israeli war, when they cut us off from oil, and you had to line up for gasoline. I lived through that. Now, and again, this is what my book Sold Out is about: the breakdown of the supply chain, partly related to energy, partly related to the war in Ukraine, partly related to the pandemic panic. As I explained in the book, it actually predates that. The breakdown started in 2018 with Trump's trade war, and then COVID made it worse, yes. Ukrainian war made it worse, yes. But it really started before that. Bare shelves, and you couldn't get certain things. It wasn't that every supermarket shelf was bare the way it was in East Germany in the 1950s, but something was always missing, and that's still the case today. So, of course, prices went up, and people were trying to pay whatever they had to get what they needed, and energy prices were a big driver of that. So that feeds through as a form of inflation. The other kind of inflation is from the demand side. So the supply side is called cost push. Costs go up, and they push it onto the consumers. The other kind is from the demand side. It's called demand pull. And basically, consumers have a change in mentality. They're worried about inflation. They would say, hey, I was thinking about buying a refrigerator. Gee, I better go buy it today, because if I wait for 6 months, the price is going to go up. Or apply that to anything, a new dress, new suit of clothes, whatever. And so you're pulling demand forward, and it's behavioral. And that will also drive prices up. But they're very different things. Now, cost push can morph into demand pull. That's what happened in the 70s. It started from the supply side, but by the late 70s, 80s, and Volcker, which we've just been talking about, it had tipped over into the demand side. That hasn't happened yet. We've had the supply side inflation, the cost push. It hasn't yet tipped into demand pull. It hasn't really affected consumer behavior that much in terms of people anticipating more inflation. It could, but it hasn't happened yet. Here's why that's an important distinction. cost push inflation negates itself. You know, the old saying that the cure for high oil prices is high oil prices because people can't afford it. Like, you know, maybe if demand is inelastic, if you got to fill up your Ford F-150 truck with gasoline to take the kids to school or go to work. But if you're unemployed, you're not buying any gas because you're not leaving the house. So it tends to negate itself, whereas demand pull feeds on itself. Powell has not made that distinction. And if I'm right, I think I am right, and the evidence backs that up, this inflation will come down, not because the Fed is raising interest rates, but because higher prices destroy demand all on their own. If I used to pay $75 to fill up my truck with gas, and now I have to pay $150, which is about right, I'll do it because I got to get to work. But that's $75 I'm not going to spend on something else. I'm not going to go out for dinner. I'm not going to go to a show, a concert, or buy a new camera, whatever it might be. So it does tend to depress demand, destroy demand, and hurt the economy. And then it slows down, and then the inflation comes down on its own. That appears to be happening. But Powell hasn't really made the distinction. He's fighting the last war. I hate to use a cliche, but he's fighting the Volcker War. And what he's got looks a little bit more like the Herbert Hoover War. That looks a little bit more like the 1930s than the 1970s. So the bottom line on all this is the Fed is going to raise rates at least twice more for the reasons I mentioned. Powell doesn't want to repeat the Volcker mistake. He thinks the battle's not won. He has to get to the terminal rate. In reality, he's probably already there, if there is such a thing as a terminal rate. It's another one of these things they made up. Inflation is coming down, and so will probably continue, but for really bad reasons. This is where now, I criticize Powell enough. Let's criticize Wall Street for a minute. They might as well just hand out pom-poms and megaphones and cheerleaders, varsity letters and all that stuff. So the Wall Street narrative is, we're there. Job creation is slow. Wage growth is slowed in real terms. It has labor force participation is not going up, at least not, just noise, kind of on a month-to-month basis. And the Fed's going to get the message. You're going to stop raising rates, soft landing, Goldilocks, and then they're going to cut rates. So buy tech stocks. That's kind of how Wall Street thinks. They're just trying to sell you some tech stocks. They're wrong too. Powell's wrong for the reasons I mentioned. Wall Street's got it wrong too, because inflation is coming down. That's empirical. There's no debate about that. But it's coming down for really bad reasons, which is the economy is hitting the wall. And not just the U.S. This is a global phenomenon. We're looking at a global recession, and they're rare. For a major economy, the U.S. or China or EU, UK, whatever, to go into recession, it happens. And then somebody else has growth, and they kind of pull everybody out of the ditch. But a global recession is highly unusual, and that appears to be what we're heading for. The other thing where the cheerleaders are out is the China reopening story. So they spent 3 years basically putting people in concentration camps, quarantine lockdowns, no travel. The examples of people, in hazmat suits welding steel bars in front of apartments so people couldn't get out because they had COVID, and they're jumping out of windows and killing themselves. Testing tents every 2 blocks. You had to be tested 3 times a week, et cetera. Horrific. It doesn't work, by the way. The virus goes where it wants. That was my last book, The New Great Depression. It's a respiratory virus. Masks don't work. The vaccines are not even vaccines. They're experimental gene therapy treatments, if you want to get it. But none of this worked. So now that we got past the 20th National People's Congress, National Party Congress, and Xi is, I call him Chairman Xi, is now emperor for life, which he is. They can kind of leave that behind. They pivoted. They say, okay, now we're just going to let it rip. We're just going to let it rip. That's the new policy. It was 100% political. None of this was ever based on medical or evidence or public policy. But he just wanted to get the third term under his belt before they let the thing rip. So isn't
that incredible that that's what they were waiting for, to basically change the entire policy for 1 billion plus people?
Correct. And when they said, and they're shameless and they're liars, and what they said was, well, our COVID, they call it zero COVID, our zero COVID lockdown policy was so successful that we can now let it rip and we'll be fine. I mean, everything about what I just said is a lie, but I read a lot of Chinese information and translation. So that is what they're saying. But what does let it rip mean? And you're right, Brian, it's 1.4 billion people. So if you assume a 30% infection rate, which is probably low, it could well be 50%, but even 30%, that's 420 million infections. And if you assume a low fatality rate, 1/4, 1%, and that's probably low, that's between 1 and 2 million dead. And not only that, they don't have the hospital facility. US, UK, Europe.
To continue watching the rest of the episode for free, visit our website londonreal.tv or click the link in the description below.